But Pankaj Pandey too joins in on the show right now. Pankaj, hi, morning. Good to have you on the show. Pankaj, now post-elections, the chatter is what the budget is going to be like, whether there's going to be any mega or big announcement. Is it going to be a status quo kind of budget? Because the next one is going to be again back in 6 months.
Hi, good morning, Aisha. Thanks for having me. I think our overall sense is that largely the bullish bias which we were carrying prior to election outcome remains intact. I think the only challenge what probably we need to sort of look at the element of populism which might come by. And if the quantum is not so high, then I think overall directionally things are going to remain intact. And I think sectoral biases and even Nifty target of 25,000 should remain intact. I think now going forward, budget and the overall earning growth of 14-15%, which is what we are estimating, I think will sort of drive the market. But our overall sense is that one needs to sort of watch out for budget plus the element of optimism. Although they have some headroom in terms of higher RBI dividend plus, obviously there can be structural savings on the subsidy side, especially related to fertilizers. So it remains to be seen how they sort of utilize. But our overall sense is that with policy continuity in place, bullish bias is intact, and all sectoral positioning with respect to capex, infra, or related beneficiaries should hold ground.
Right, Pankaj, morning. We were closely monitoring what was happening when it came to the entire FMCG space, especially post that election verdict initially. But it turned out to be a bit of a flash in the pan move. Do you believe that there's actually merit in looking at this space for the long haul?
I think this is one space which is done very well when the most of the segments of the market were not doing well. And our sense is that at best, even with a better monsoon, we might be looking at a 9 to 10% kind of a lower or a higher, lower double digit kind of a growth at max, which means that they are not going to sort of outperform Nifty. And on top of it, when you look at some of the commentary that most of the companies have been sort of driving the growth through better margins, and with the local brands sort of competing well, our sense is that there will be pressure on the margins. And which is why we feel that this is one space one should not be sort of positioning too much from a portfolio perspective. We're not structurally be positive on this space.
Sure. The other space in focus, or rather the stock I should say, is going to be Mankind Pharma. We just flagged off a Motilal Oswal note for you. They've initiated a buy on this one with the target price of 26.50, 22.25 is where Mankind is currently. Pankaj, I don't know how closely you've been tracking it, but the sheer diversification and the kind of scope of business that they could have in chronic therapies is something that should excite the street and perhaps give a longer growth runway as well to the company.
So Aisha, we don't have a coverage on Mankind, but what we are liking in pharma is something like Aurobindo, because Aurobindo last quarter did very well, especially in the US side. And I think when you look at their specialty plus the injectable segment, that contribution is about 24% of their overall US sales. And margin profile is expected to be good at 22.5%, which is what we are penciling in. And this stock is trading at 13-14 times. So I think US growth in general is expected to be better. And I think Aurobindo looks good to us with a target price of 14.75.
There's also a trend that we'll be closely watching out for. And, they came out with some key takeaways as well about store expansion and basically talking about runway for growth for their top three brands. Pankaj, if we had to, look at some of the listed players within this retail space, who do you believe would emerge on top?
So Trent obviously has been sort of leading the pack with a growth rate which none of the other players are able to sort of deliver. The challenge with Trent is that despite leading the kind of growth what they are sort of delivering, this stock is very well priced. And while our sense is that probably in the second half, we might see some recovery in some of the retail plays, but we still sort of wait and watch situation in most of the companies. Trend being sufficiently valued, I think we would not be sort of chasing this stock at current levels.
They joined us now, and let's connect with them. Pankaj, what are you telling your clients now? Clearly the event adjustment is behind us. Is it back to square one? Should market just forget last week's volatility and move on?
Absolutely, Nikunj. I think what we are clearly sort of advising client is that we are back to square one in terms of bullish bias. And sectorally, the entire capex infra-related teams are back in action. But I think there is a slight change in terms of, so for example, cement is one space which hasn't really done too much in terms of price performance. Last quarter was soft because for whatever companies we cover, the volume growth continues to be good at 13 odd percent, but pricing had been softer. So that led to a softer EBITDA per ton. But our sense is that with the kind of announcement which is coming up, we see this is one sector which can sort of continue to sort of or should outperform. And metal is another pack which is sort of interesting. Last 5 quarters, we haven't seen EBITDA per ton improvement for most of the companies. But our sense is that in case any overall better growth in China, ideally should help these companies, or any kind of a measure which the government takes should help these companies, because this is another space where we are seeing a lot of capex happening. So that is another, and infra is another space which we are liking in bits and pieces. So from that perspective, there are select pockets which are looking good. Capital goods, we would want to sort of play more through the bearing companies, because that is where we are seeing revival, especially on the export side. And so one needs to be sort of selective in the capital goods, because given this sort of sharp run of what we have seen, I think defense is again back with the kind of price correction we've seen. I think the potential opportunity is quite large, and which is why I feel that defense will continue to sort of do well.
Okay. There's also Nykaa that's in the spotlight today. Two brokerage notes, generally an overweight and a buy rating coming in on the stock, talking about how some of the newer personal care categories are growing quite well. Give us a sense, Pankaj, as to whether or not you've hopped on the wagon for any of these new age tech plays, Nykaa in particular, and how some of them are performing, if so.
So we've been avoiding the new listings and some of these new age companies largely because, one, I think things need to sort of evolve more. Plus, valuation is something which we are still sort of not very comfortable with a lot of names. So we're still sort of chasing traditional businesses. So this company we have been sort of missing for some time.
What exactly have you bought post the verdict, post the election verdict, which is 4th of June?
The question is for me?
That's right, Pankaj.
So what we've been sort of recommending is, say, a company like Sagar Cement, which is trading at, say, $50 kind of a valuation. Then you have Birla Corporation, which we have been liking. I think our sense is that next 2 years, you should see improvement in the EBITDA per ton. We've been recommending some of the infra names like, say, NCC, where we are comfortable in terms of margins largely remaining intact and double-digit kind of a growth. Then we see a large hydroelectric opportunity unfolding, and Patel is one company which looks rightly poised for this growth. There we have a target price of 20. So these are some of the names which we have been sort of recommending.
Reason why you like cement and you like mid-cap cement?
So when you look at Nikunj, the tier one players, it's not that we are not liking tier one. So tier ones, if you look at, say, for example, between ACC and Ambuja, Ambuja is trading at 16 times EV by EBITDA, something similar what Ultratech is also trading. But ACC is trading at about 10, 11 times. So our sense is that overall there is a great amount of difference between the tier one and tier twos. And we feel that while the tide will improve for most of the players, but the upside is going to be larger in the mid cap and smaller cap names.
Nuresh, there was a pre-election trade, and now markets will start talking about the pre-budget trade. In the run-up to the budget, which could be a month from today, what could be the positioning of the market?
So going into the budget, the only names which could really actually come back into reckoning is, say, agri-related names or consumer-related names. Because those are the two sectors where there could be a direct implication, because what we've seen is the earlier trades used to be railways and say defense, etc., which would see some bit of an allocation change. But we've seen those orders continue all through the year. So if one has to take a trade purely for that event, so it could be agri, so you could look at fertilizer names and agrochemicals, and then consumption names, because consumption as a basket has started turning around. So this would be the two trades which could be purely a budget trade. Apart from that, we've started seeing more actions all through the year instead of the budget. So would be looking at these two names as a possible trade for the budget.
Pankaj, when you say specifically you like defense, there is a big private defense sector which is also at play. And last year, a lot of new companies from the defense space have gone public. Anything interesting from the private defense space? I mean, if you say about BAL, HAL, those are popular stocks. Anything interesting which is defense but yet slightly less or unknown?
So, Nikunj, we were liking two companies. Data pattern is something which we initially wrote, but I think valuations are a bit difficult to sort of justify. So, but I think what we are liking is Astra Microwave. Our sense is that their contribution to the ASR radar and with the kind of expected ramp up, what we see in the Tejas Mark 1A or Mark 2A production going forward, I think this company should have a decent role to play. And so this is another company which we are liking in the defense, especially on the private side.
Okay, fair enough. Meantime, let's just get in a take from our chartists as well. And Naresh, wanted to get in your views then, given the fact that the broader markets as well were holding out quite smartly. Would you be looking at some of those railway and defense stocks as a strong upside on the charts?
So for now, the problem is they've rallied way too much. So in terms of defense, would avoid. But if one wants to look at it, then it could be say private defense companies or something like very small names out there. So there is a Zen Technologies, there is a Avantel, there is a Premier Explosives. So Quasi plays more on the private side, a Dynamatic Technology. So would be a little careful on the PSU names because volatility will increase going forward. But I would be looking at more names on the private side, on the defense side.
Okay, there you have it. That's a view coming in on some of those stocks. Meantime, Pankaj, what's the view when it comes to something like the insurance sector, given the view that de-rating is overdone according to UBS? Where do you stand?
So I think when you sort of look at the recent impact, our sense is that higher surrender values will have some impact because even with a persistency ratio of 85%, there is an impact on the margins. What we are liking is, which is across chain, is say hospitals and the health insurers. So while I can't talk about ICICI Lombard, but I think Star Health looks good to us because company is guiding for better than industry growth rate. They're likely to sort of maintain market share. And we are liking the hospital as a space from a consumption perspective because last 4 years we have seen 15% kind of a top line growth and largely coming from 10% kind of a pricing growth and 5% kind of a bed increase growth. And our sense is that you have still levers in terms of the share of private insurers going up. Then I think medical tourism is another factor which should sort of keep the sector buoyant. And we are looking at some 35-40% kind of a capacity increase in the bidding. So I think the growth also is a comfort. And we are also hoping that the government will keep focus on Ayushman Bharat going forward. So from that perspective, I think the entire value chain looks good to us.
Naresh, let's go back to Reliance because that was your call in the morning. Why do you like Reliance?
So technically, if you look at Reliance, for the last 4 months, the bottom range has been 2,800 roughly. On the top, it has been 2,950 to 3,000. On the exit poll day, the stock crossed into a new all-time high, went above the 3,000 mark, and then it corrected. Now, majority of the names post the election dip have recovered and gone back to those previous highs. If you look at the structure and remove out that day, we are on verge of a breakout about 2,950, 2,970. So if you remove the exit poll day, we are very close to a breakout. And once this breakout happens, we could be actually seeing Reliance take leadership. So it's a preemptive buy here. Ideally, once it sustains 2,970, 3,000, it looks all the more interesting. And once that happens, the last range is roughly 200 points. So minimum case of 3,200 comes into play.
All right, let's find out then what some of those mid-cap strategies are as well as we're waiting by for those pre-open rates to kick in and owing by what the US Fed has done and the kind of healthy handover that we've gotten from Wall Street as well as the Asian markets. Indications are going by the GIFT Nifty as well that it could be a fairly decent start. Kunal, your top mid-cap call?
That'll be a buy on Usha Martin. That's a stock which is looking very attractive on the chart. So I think over the last 3 months to 4 months, the stock was trading into a range consolidation 375 as the resistance for the stock, and closer to 340, 350. There was slew of supports for the stock, both in terms of price as well as moving averages. Now that the stock has confirmed a breakout about 375 mark, I believe that the stock looks attractive for a breakout closer to that 400, 425 levels also over the near term. So keeping 400 as an initial target for the stock, stop loss at 365.
Okay, let's get in your take. Naresh, your top mid-cap call?
So that would be a buy on Lumax Autotech. We are seeing a breakout across the auto ancillary space. So Lumax Autotech is another breakout, which is a breakout very close to getting into a new all-time highs as well. The group company Lumax Industries has also broken out. So looking at this as a play towards 600, stop loss at 480.
Pankaj, should we extend that question to you? If you had to look at some interesting stocks within the broader markets, what is it that would come to mind? Pankaj,
The question is,
yeah.
So, like I highlighted, we are liking Sagar Cement with a target price of 305, Birla Corporation with a target price of 1870, and then Patel with a target price of 80. And so, I think besides that, banking is another which we are quite positive on. I think this is one sector which hasn't done much in terms of price performance. We're liking the tier one PSU pack like SBI and Bob, and within private, it will be Axis Bank.
All right, Pankaj, thanks so much for taking time out and joining in with your take on the markets as well as some interesting stock recommendations.
If you like this video, then like, share and subscribe to ET Now.